Hello YouTube, step index on a daily time frame. I know it's been a while since I've spoke about this particular instrument from Deriv. It's a synthetic indice and I like how it moves. So from time to time, I will be sharing out some of these technical science type of lessons in this YouTube channel. So we are looking at a daily time frame, and we've seen the displacement for July's price action. And what I want to speak more of in this particular video, it is the market phases. We had the daily fair value gap CB, and this daily fair value gap supporting price to the downside, leading up into this low and that low and this low, situated at this daily fair value gap, right? So this is sell-side liquidity. So in July's price action, price opened up into the daily CB, respected that as a resistance, and went lower to take out all of this liquidity pools. And we had the 12 February 2025 sell-side liquidity noted as the draw on liquidity. This is where I was calling price lower, right? So yeah, we did have our delivery of price action to the downside, and right about mid-month of July's price action, I noted how this price action retraced, almost filling in this inefficiency, but it failed, as we can see. And from there, we stayed in a consolidation. So the market phases that always are available for the market, you can be a swing trader following this expansion movement right in the opening of July's price action. And by mid-month of July, you are out of that short position. You would have taken out the optimal, draw on liquidity, the terminus for that particular swing trade down here. So you could be participating in a short opportunity, and after that sell-side liquidity pool has been taken, we are now met with a consolidation market. Okay, it is really painful to trade in these market conditions. It is really painful. Okay, not unless you are a scalper. So if you're a scalper, you would be down here trying to take in these short-term little scalps in the marketplace. But this is not high probability. Okay, this is not high probability. So what is the high probability setups, my guy? Okay, if we zoom in a little bit for our step index, okay, we had this buy side liquidity pool, which is the mid-month of July, swept. We had it swept, and we displaced lower. We did a market structure shift. We left the fair value gap. So today we came inside of that fair value gap, right? And look at the reaction. We are moving away from the fair value gap. What have we done? We have taken out everybody who has been trailing their short position in July's price action. These guys placed their stop losses up here. So when the new month opened, we rallied to the upside, took out everybody who was trailing their stop loss into this high. We broke lower. We even printed a fair value gap. So this tells me that price action wants to go down here. So how would we participate in the market going down here? Okay, that would be the discussion for lower time frames. Okay, the 4-hour time frame, we are in the August opening. We did rally to the upside. We took out this buy-side liquidity, the mid-month high of July's price action. We swept that, and we had this breakdown sweeping this particular low, and that is actually a market structure shift. Okay, price rallying to the downside, creating our market structure shift. It left the daily fair value gap, but when we transpose the daily fair value gap into a smaller time frame, like the 4-hour time frame, we get this 4-hour time frame fair value gap. So this is our 4-hour time frame fair value gap. And what are we doing with this fair value gap? We are looking at the order flow in this fair value gap, because the daily won't do it for us, because it takes 24 hours to confirm what price is doing at a key resistance. So we drop lower into lower time frames. We get a 4-hour interval to confirm that this particular resistance is holding and it's doing its job. So here is the consequent enroachment of the 4-hour time frame fair value gap. It is being respected as well. Okay, so out of this fair value gap, we can then define our lower time frame entries, like the 15 minutes time frame. Where is the draw on liquidity, guys? The relative equal lows, like this one, it is close to this low, and this particular low is close to all of these sell-side liquidity pools. So what's really down here? It is orders. It is smart money that is going to take their short positions and close them down here. Okay, so let's hop onto the 15 minutes time frame for our entries. Step index on a 15 minutes time frame. We are going to be discussing inefficiencies and highs. That ties up to a whole complete market structure entirely. If you're going to look at highs and lows individually and not considering the inefficiencies in between those highs and lows, well, good luck to trading that way, because it's rather difficult for me, and I love fair value gaps, honestly, but this particular instrument, it always tends to want to fill in the inefficiencies whole, and that is not how we usually trade the ICT market structure. We want to see the fair value gap being left open to a certain degree, ideally the 50% of that particular inefficiency. It makes it difficult, trading this particular instrument on the lower time frames, because you will get to see that inefficiencies are actually getting filled majority of the time. Okay, this pair moves a lot quicker than anything that I've traded before. Okay, it's really insane. So this particular instrument, it's rather, I can say, sometimes easy, but majority of the time, if you don't know what you're doing, you're gonna be in trouble with this particular instrument. Okay, in my previous videos, back when I was still pushing the month-end agenda, well, look at the consolidation that occurred right in the month end, of July. It was a consolidation market. You couldn't make any high probability conditions with this particular market structure. Okay, it's rather difficult, choppy, aimless. So this particular consolidation, it occurs for a particular reason. Because price had previously displaced lower in the opening. That is the reason why we're having a consolidation in the month end. Okay, let me zoom out a little bit, okay, so that you see this. In the opening of July, we had that displacement in response to the higher time frame inefficiencies, like this particular fair value gap and the daily CB. Okay, price displaced lower. There are inefficiencies in the way that were printed when price was displacing lower like this. It was quick, moving lower. Okay. Along the way, we wanted to fill in those inefficiencies. But as we can see, price stopped right here, dead in its tracks, and went lower. So what price was doing up here, it was printing in the mid-month high. After this particular high, it was choppy price action. Okay. So right about the mid-month, a lot of these individuals that shorted the market up here, they placed their stop loss right here. Okay, right here. And a lot of other individuals are doing the same. They are looking at this high as a means of a resistance. But the problem with that particular resistance is that price action tends to sweep those particular highs. Okay, that is the primary model of this particular price engine. It moves from highs to inefficiencies. It's mainly doing those two things. Okay, but when does it attack these particular highs and lows? Okay, we had this particular consolidation all through month end, and when we began a new trading month in August, we rallied to the upside. We swept this particular high. Who is in this particular high? It's those guys that sold short in the beginning of July. They trailed their stop loss here. When we opened for August, what do? We went higher to take out anybody who is holding their short positions. That is how price engine works. It takes out everybody who has been profitable. Okay. Suppose that particular individual knows that the market is still primed to go lower, even though it just bumped this high and took him out of his short position. He waits for these particular confluences. Does the market want to continue going higher? If so, it will want to prove that it wants to go up and stay above this particular high as it breaks it. That would then change his mind into being bullish. But what are we seeing here? We are seeing a market structure shift, breaking this particular low. It's printing that particular fast movement price action that is doing what? It's printing a fair value gap. It's moving quick. It's going to leave inefficiencies. It's not going to stay range bound like this. It moves rather quickly after taking out this particular high. Okay. It breaks this particular low, creates a market structure shift. Okay. It continues going lower to print these particular relative equal lows. It then proceeds to go higher into the inefficiency. And if you're looking at this particular high as a resistance, then you're in the way, my guy. You're in the way. Okay. What price is doing up here, it is observing the 4-hour time frame fair value gap consequent enroachment. How we trade inside of that particular key level is very important, because this particular resistance, price trading inside of that inefficiency, we don't sell short just because price is trading inside of an inefficiency. No, we look at the storyline, the context, and the narrative. Could price really use this particular inefficiency to go lower? If so, what are the criteria for that particular setup happening? Well, number one, it would have to respect the higher time frame key levels. We have the daily fair value gap high and the daily fair value gap low down here. So this is a higher time frame fair value gap on the daily. We trade inside of it, and we had respected that particular daily fair value gap, which is now being transposed to the 4-hour time frame. Also, the consequent enroachment is being respected. Okay, a lot of confluences up here. When you zoom in into the 4-hour time frame fair value gap and the daily fair value gap as a resistance, what price is doing inside of this inefficiency, it is attempting to fill in the fair value gap, but what happens is that it fails. It tells you something about order flow. It is later confirmed with a market structure shift, because price is moving away from the 4-hour time frame fair value gap, consequent enroachment with this particular fair value gap, and this particular fair value gap as well, offering resistance. So there are two opportunities that you could have attempted above this particular high, raiding this particular liquidity that is sitting at the daily fair value gap low. We sweep that, and we don't stay much longer above this particular key level, do we? No, we just rebalance the lower half of the inefficiency. How do we do that? We trade up and down with these particular key levels. So you can split the daily fair value gap or the 4-hour time frame fair value gap into quadrants, because this is a large inefficiency. It is extreme. So in this case, we are allowed to split inefficiencies into lower quadrants. Okay, so we got the 50% here with this particular fair value gap offering resistance. So if you're selling short at the 50% of this fair value gap lower quadrant, by the way, this is the upper quadrant and this is the lower quadrant, we're going to see how price behaved in the upper quadrant with this particular high as well. But notice that it is just coming up into 75%, failing to get to the 100%, dropping lower, market structure shift, fair value gap, but the consequent enroachment 50%. Does it respect that beautifully? Drives price lower, market structure shift here, and I loved this particular inefficiency. It is a lot larger than these particular two inefficiencies. Do you notice that? Order flow, good people. We trade inside of the fair value gap. We touch the daily fair value gap low. Yes, we touch this particular high. If almost fills in the fair value gap, we almost fill in the fair value gap, but we want what price action is doing here, it's not supposed to fill in this particular fair value gap, because it is reaching up as well into the daily fair value gap low. So this could be an ideal short scenario if you are late and missed out on these two opportunities. Yeah, you could still catch the train, buddy. Price displaces lower and it prints relative equal lows. So along the way, you're just looking for relative equal lows going to the downside. This is an example of it. Price does not like to leave relative equal lows, especially if it is primed to go lower, meaning that this particular high that it just printed here, it is the smart money reversal high. Down here we have the consolidation, accumulation inside of the fair value gap, distribution outside of the fair value gap, going lower. Okay, so this particular high, let's take the high of the inefficiency on the 4-hour time frame right here. See how it fails to get to the 50% of the upper quadrants? Fails. That is order flow right here. Beautiful. Okay, so there are other opportunities in here that you could attempt as well, and even this one as well, showing you that there is a shorting opportunity up here, even though we spent a little bit of time consolidating, contemplating whether we want to attack these particular relative equal lows or not. But yeah, this particular shorting opportunity would be ideal to anticipate these lows getting ran through. Okay, we want to see price going through these particular lows, to and through. Okay, so hopefully you enjoyed this particular video and you learned about inefficiencies.